This is the easiest way to understand privatized banking. To understand privatized banking, we first need to know how a bank operates. Banks are in the business of lending money to make money. Let's say that you enter the picture and you decide that you want to deposit $1 million inside of a bank. The bank is then going to lose money. Let's say that the bank is going to give you 1% for storing your capital inside the bank. But then let's say I enter the picture because I want to use bank money to go buy a house. I'm going to go to the bank and let's say I take out a mortgage for the amount of $100,000 to go buy that house. So 100K is going to leave the bank, but then the bank is going to receive money when I pay interest for my mortgage back to the bank. For this case, let's say that I have a 7% mortgage. All the bank is doing is what's called positive arbitrage. They're keeping the split between the gain and the cost of capital. Now you may think the total rate of return here is simply going to be the gain minus the cost of capital, but that's not the entire equation. The entire equation is the gain minus the cost of capital all over the cost of capital. This is a total return of 600%. When we look at this from a bird's eye view, banks are simply lending money to make money. They are lending money to folks for purchases, but then are making money via inbound payments. Let's examine this process again with a system a lot of people are familiar with, which is a HELOC. So let's say that I enter the picture again, and I want to go buy another asset by extracting equity out of my current house. This is how HELOCs work. When someone pays their mortgage into the house is going to build equity. Then you could access some of this equity via a loan. Let's say that I want to action a HELOC and take out 100K of equity from my house. I'm going to receive that 100K, but then I will pay interest on that capital that I just extracted. HELOCs are typically going to be 1 to 2% more than the market. For this explanation, let's say our HELOC capital rate is going to be 8%. I can then use that capital that is extracted to go buy another asset. For this example, let's say that I decide to buy another house. I will then take that 100K to go purchase the house, but then that house is going to give me a rate of return. For this example, let's say that I earn 15% on that house. So here we can see that positive arbitrage again. We are taking the split between our gain and the cost of capital. We are applying the concept of leverage. We're using other people's money, in this example, bank money, to go buy assets. So let's apply the same scenario. Let's say that I decide to go buy a house, but this time I use a properly structured and funded whole life insurance policy as the bank to go buy my asset. Remember, with houses, we pay our mortgage and build up equity. The same concept applies to a properly structured whole life insurance policy. Only in this case, we pay our premiums kind of like the mortgage inside of a house, which will build up cash value, which is very similar to equity inside of our house. We can then access the equity or cash value inside this house to go buy assets. For this example again, let's say we go to our leverage source and we take out 100K to go buy our house. We receive our 100K, but then remember, we will pay interest to the insurance company in this case, but the cost of capital in this scenario is going to be about 1 to 2% less than the market. With whole life policies, you get access to cheap and flexible debt. For this example, let's say that our cost of capital is going to be 5%. It's also important to know that this debt is flexible. There is no structured payback structures when you take out this loan from your whole life policy. That is because when you die, the total amount of death benefit passed on to you is the death benefit minus outstanding leverage. Life insurance companies know that everyone is going to die. So you have flexibility with this debt, which is very beneficial from a real estate and business point of view. It's not advised to let that interest ride, but it gives you flexibility with your leverage source. In addition, if you pay off that interest quicker, it will restore your cash value so you could go buy more assets. So going through this example again, $100,000 is going to leave us to go buy our asset. And then again, this house, let's say it's going to net us 15%. And just like a bank, we're going to keep a split between those two numbers from our gain and the cost of capital. Just like a bank and just like a HELOC, we are leveraging money to make money. We are applying leverage. We're using other people's money, this time life insurance company money, to go buy assets. But here's the critical thing with a properly structured whole life policy. When you apply leverage from your whole life policy, your money remains intact and continues to grow tax-free, even though you apply leverage out. For this example, let's say that I had $200,000 in my life insurance policy. And remember, we took out 100K from our policy to go buy our asset. For this scenario, we would continue to gain interest and dividends tax-free at 200K. We are applying leverage. We are using life insurance company money to go buy our asset while our money remains intact and continues to grow tax-free inside of our whole life policy. Remember, banks are in the business of lending money to make money. You could do the same thing. Hypothetically, it doesn't matter where your capital comes from. It just so happens that a properly structured and properly funded whole life insurance policy is one of the best vehicles you could use to apply the process of becoming a banker. Let's examine some additional benefits from a properly structured and fully funded whole life insurance policy. Because you have a contract with the insurance company, you have protection. You are given access to a death benefit. This death benefit is received by your heirs tax-free and probate-free, which is very important when we're talking estate planning. In addition, a portion of your return inside the policy is going to be guaranteed. That's something a lot of vehicles can't do inside the wealth building community. In addition, you will have retirement benefits. Remember, all of the growth inside your policy is going to be tax-free. In addition, there's no red tape restrictions like there are with different government accounts. Finally, we have the concept of leverage. Remember, we could apply leverage and go use life insurance company money to go buy assets, while our money remains intact and continues to grow tax-free. We give our dollars a second job. Its first job is to work inside of the whole life insurance policy. And then when we apply leverage, we could go use that to go buy assets. That money is then working both inside of the policy and then outside of the policy inside of the deal. Be very cautious with the people that you work with inside of the insurance community. The policy designs that we talked about in this video have to be set up in a very specific way. When working with your agent, start with your goals. Talk about the intent and end state of what you are trying to pursue and when you're trying to get there. Then backwards plan and create the right design that is right for you to help you reach your goals in the most efficient way possible. I hope you enjoyed this video. Applying these same principles inside this video has allowed me to scale my real estate portfolio way quicker, and it's allowed me to pursue my philanthropic vision in the martial arts and disabled communities at a way higher rate. So thank you for watching and stay tuned for more.